Welcome, welcome, welcome to Wealth Strategies Unleashed. I'm Robert Gilliland, and again this week we are very, very, very fortunate to have Troy Gayeski with FS Investments here with us. Just that we've had him on a couple different podcasts. He has had a huge illustrious career, and he is the chief market strategist for FS Investments. And so, Troy, thanks for joining us. Super excited to have you with us again. Always learn a lot. And so thanks.
Yeah, Robert, it's great to be back on. Looking forward to another exciting podcast with you, brother.
And so, one of the things in the last several weeks, I guess is a better way to say it, a lot of people, those I think you call them perma bears, right? I think you mentioned that, saying, "Oh, we're heading down. The economy's gonna be terrible." The markets themselves are actually wanting the Federal Reserve to cut, and the Fed only cuts when the economy is slowing or things aren't going great. Here's my question for you. Is this economy still strong?
Yeah, so the good news is the economy is still in very good shape. We can't expect the same growth that we got last year, but recession risk has receded dramatically. However, you know, to be fair, there's probability distribution of outcomes, meaning there's no guarantee of a positive outcome or a negative outcome. The negative outcomes for the economy have receded substantially. Positive outcomes have increased a lot. But there are warning signs, to be fair. We're generally constructive. We have what we refer to as this dare to dream scenario that we started to concoct last August when it seemed a lot less probable that we could easily skirt recession. And part of it is tied to a lot of the assets we manage. We do a lot of senior private lending, which are floating rate strategies. And in general, we like higher rates in the front end and less risk of recession, right? Because what happens is when rates stay higher for longer, you make more income for clients. But in a recession, you give back some of that income because of defaults, right?
Right.
So the dream scenario and what we've basically been rooting for since November of 21 is for the Fed to hike rates as much as possible without collapsing the economy, right? And not only have they hiked a lot, the probability of keeping rates high for longer has gone up dramatically, and the risk of recession has receded. So it's kind of this almost too good to be true, dare to dream scenario for private lenders, and we're just very happy for our investors that it's turned out to be such a positive outcome.
So if you were an investor, and you are an investor. So when you look at this, what sort of, if warning signs are out there, what would you be paying attention to? Because you've got, when you're not in the middle of earnings season, every minute economic piece of data moves the market. If they're off by two people on the number of unemployment, the market either goes up or down depending on whether it was two more or two less, right? Or what these different numbers, we become very data dependent. But what would you say are kind of the most important ones that people should keep an eye on to see where those trends are going?
Yeah, so I think the one thing to remember, and this is mainly for bond market participants that have been somewhat, I guess delusional might be not the friendliest term, but somewhat confused in terms of how aggressively the Fed would cut rates, is that, look, we're not having a recession anytime soon. And by soon, I mean next 3, 6, 9 months. The probability of that is extremely low now. 12 to 18 months obviously goes up a bit. And the Fed has done a wonderful job bringing inflation down. They were clueless about inflation surging, but they've done a wonderful job bringing inflation down. We went from 9 handle on CPI to around 3-ish, give or take. But going from 3 to 2 is a lot harder, right? And a lot of that's tied to the demographics of the labor market, the fact that we no longer have this tremendous Chinese labor pool, the greatest labor shock in the history of mankind. So that means the Fed's not cutting rates anytime soon, which means you just don't have a lot of upside in fixed income and could have downside. But in terms of what concerns, there's really 3 things that concern me the most. And if you can paint a recessionary scenario within a rational time horizon, these would be 3, contributing factors. One is withholding tax growth. So withholding tax growth is Well, first of all, stepping back, the labor market is almost by definition every data series is lagging, right? It's telling you about what past and the future. Um, but within labor market data, withholding tax growth is the most real time indicator of how much income is being held back by the federal government. And so what's you've seen historically is it's been a fairly good indicator about when you're about to enter a mild recession. It nailed the 2001 recession, nailed the global financial crisis. You didn't need withholding tax growth to tell you that things were going to heck in a handbasket in a pandemic. And there's really only been one false signal, and that was 2018 when the Fed was hiking because of the threat of inflation, the pyrrhic dream or fantasy of inflation, as opposed to it being a real deal. Um, so that data series went modestly negative in Q2 of last year, was negative again in Q3, more negative in Q4, and so far in Q1 it started on negative. So what that is telling you is that beneath the surface, the labor market is modestly weakening. A lot of other data would point to a warm to red hot labor market. But there's also a very logical explanation, Robert, in that when you look at this economy and this labor market, where have the job losses predominantly been? They've been in technology and financial services, right? High paying jobs at higher tax brackets where blue collar, are you kidding me? Our kids should be electricians, right? Or or plumbers, right? Blue collar jobs, service jobs, booming, 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 booming. So this could be another false signal, but when you combine that with the fact that the excess savings that was hoarded during the pandemic has almost run out, and our savings rate as a country has dropped from 7.5 pre-pandemic to now 3.5%. It just tells you that there's a lot less shock absorption capability left in the U.S. consumer today than there was coming into 22 when every contributor to GDP went negative other than consumption,
Right.
right? Consumption. So if you start to have things a mild shock or for some unknown reason that makes no sense to us, we have layoffs that start to percolate in other industries in a meaningful fashion, not in a headline grabbing fashion. There's just less shock absorption capability. So those are two things that concern us: the dramatic drop in almost complete exhaustion of excess savings, lower savings rates, and withholding tax growth going negative. And then the third factor, and this is more market related, is the Fed continues to drain their balance sheet at the fastest pace in history. Money supply has either been stagnating or contracting for a record amount of time relative to any time in the history of the economy the last 100+ years, other than the Great Depression. And we all obviously have a very precarious deficit situation in the U.S. federal government. So you can't rule out another liquidity shock of some degree like we had in 2018. Less economy related, more market related, but you tie that to where valuations are in equities, and the fact that we're now spending more on interest service costs in the U.S. than we are on defense. There are left tails out there, so we don't want to be Pollyannish that everything's fine. But again, that's one of the reasons why you embrace alternatives to mitigate that volatility if there's some type of 2, 3, 4 month crack in the system.
So you brought up alternative investments, and I'm going through and I'm thinking about just kind of trying to remember about a time that was kind of similar to this, and I don't know that I can exactly come up with one that is similar, but I'm sure that there are. At a time where you have equity valuations that are higher than average, so your upside may be your upside potential by investing in equities may be just what I think we've talked about in past podcasts. Say that twice fast. The opportunity for performance is it's going to be difficult to get these 26.29% returns going forward on equities. That just doesn't happen. We're reverting to the mean. Fixed income, without the Federal Reserve meaningfully dropping rates, which would mean that there's really bad things happening, rates are staying higher for longer. What should people be doing? What should people be doing if the upside's not this 20, 30%, which I worry that people are getting used to, and you got risk on fixed income?
Yeah. So to your point on equities, people forget, but from '09, the bear market bottom of the global financial crisis to the end of 21, um, equity multiples went from 9 times forward earnings to 21.2, right? And here we are today, we're at 20.6. So naturally, even with the earnings power, the cash flow power of mega cap tech and Eli Lilly and a handful of other companies, you're just going to have more muted returns. And if something goes wrong, like for instance, imagine if Nvidia's earnings went wrong the other day, um, it could have been highly problematic, right, for markets. So if you're looking at growth, right, which is the whole reason to be invested in equities, the good news is you do have democratized options now. We're big fans of middle market private equity that can be accessed by typically the average investor because you have cheaper valuations, you have less leverage at the corporate entity, you have various monetization options with smaller companies that just aren't prevalent for larger companies. And then on top of that, you have this very unique situation where you have over allocated institutions to private equity that are selling down stakes at discounts, what's known as the secondary market. So we're very confident that that strategy can at least compete with equities at these valuations. Not necessarily going to outperform over any month or quarter or even year, but over a 3 to 5 year period, should at least give you similar returns, if not better, with a lot less volatility and dramatic change in valuation. What some refer to as statement risk. Like you think everything's fine, and then you look at your state like, well, wait, how did I
What
lose twenty
happened?
percent of
Yeah.
this, right? Like, and there may have been a good reason, or it may have had nothing to do with anything, right? It was
Right.
just kookiness. Um, and so when you're thinking about reducing equity risk for growth, um, we would never argue you should reduce U.S. equity risk to do Europe or take a flyer on China now and hope that they figure it out. India is a great growth story, but how much of your portfolio are you going to put in India? The Middle East, 20 years from now, who knows? Could be great. It's kind of a rough part of the world. And we know Japan's having a moment, but the growth in Japan has been non-existent forever. So U.S. is the place to be for growth. And instead of having all your equity risk in liquid equities, which in a very narrow, expensive market, you can hive off some of that to private equity with an emphasis on secondaries. And then in fixed income, it continues to be a challenge to generate any return above your income the last several years. So 2021, you basically were slightly down. Your price declines outstripped your income modestly. 22, complete train wreck. Last year, fortunately, you made your income without any price loss or decline. This year, we're starting out again in the red for fixed income instruments for some of the reasons you mentioned. So there, you have options in private credit, whether it's real estate lending, senior the capital structure, whether it's lending to corporate entities, where you're thinking, high single digits to maybe 10% type distributions of income. In some cases, you have a tax equivalent or a tax benefit. In other cases, you do not. And again, you don't have the complete dependence on the Fed, or if you're long fixed income now, you're basically in a perverse way rooting for a recession because that's the only environment where you make money. But if that happens, you're going to get hit on your equity exposure, so you don't like that too much. And so no one's arguing if you historically had 40% in fixed income, you should have zero, but it should be meaningfully less than it was, 5, 7, 10, 15 years ago when we were in the middle of this tremendous 40-year bond bull market. Like
Right.
those days are over. They've been over for a while.
Right. It just seems to me that investors, if all of a sudden you woke up and last year was your first year to invest, you would have this expectation that markets are going to, it's easy, right?
Yeah.
Especially if you own one of seven companies or all seven companies, right? It's pretty easy. The reality is that it's going to be much more difficult, and that allocation, what you're investing in, actually makes a lot of sense because with that volatility, having some of these alternative investment classes and like you described, the different classes inside of alternative investments, which means you have to be able to be diversified, whether that's a fund of funds or many different ones, is really what's going to help you achieve your financial goals.
That's right. That's right. And like, mission one, don't lose money. Mission two, generate an attractive return that's meaningfully above inflation, right? And don't cause undue stress in times of market panics, right?
Right.
And I do think we've talked about a lot of different concepts. Whether it's markets, the economy, alternatives, democratized alternatives. But I really think the industry shined in 22 when you had such a terrible outcome for 60/40, and the majority of alternative strategies were positive, right? In some cases, only 3%, in other cases, 8, 9, or 10. But to have a positive outcome in a year like that, which 23 was the mirror image of, right? And before that, you had 20 and 21, this post-pandemic green light go environment. But you and I are old enough to remember 1964 to 1982. Like, fortunately, we didn't live through the
Yep.
early stages of that, but we've studied it. And in the last decade, where after the internet bubble, you had no returns for 10 years, zero,
Right.
right? We're not calling for that. We're just saying that returns are going to be harder from this point forward than they were from '09 to 21 and in the calendar year of 23. And so if you can find things that can generate high single digit or low teen returns and generate that performance in a different manner, it adds a lot of value. And just to close off on this theme of democratization of alternatives, and to dive a little bit deeper into what's going on in private equity right now. So I've been doing this 23 years. Democratizing alternatives was always about taking sophisticated strategies that only institutions could access and package them in a way that average investors could access without diluting the investment outcomes. Easy to say, hard to do, but we made a lot of progress. In private equity secondaries right now, it has been and may forever be the only time we've seen slower moving smaller investors take advantage of over allocated institutions to a particular asset class.
Hmm.
70% of money that's flowed into private equity has come in the last 6 to 7 years.
Right.
Some institutions are over allocated because the payouts from those vehicles has slowed. So they're in the process of selling down stakes, and much of the liquidity that's coming in to buy those stakes at discounts to the net asset value are coming from smaller investors through democratized private equity vehicles. So that is such a cool thing, right? Like, where you may have missed the last 20 years, but you have a several year window where, because of decisions of other entities and some bad luck, you can buy assets at a discount and help boost your total return above and beyond the returns that can be generated from earnings growth and revenue growth and business improvements.
That is so. That's huge, right? So where we started this off was talking about warning signs and the economy, and to just kind of pull this all back together, as it stands right here, the economy seems to be relatively strong, not as strong as maybe what it was last year. We're not standing on the precipice of a major downturn or a major recession, but the opportunities for upside probably aren't. We can't expect to get the same type of returns in 2024 that we got in 2023 and going forward. And the reality is that you probably need to be looking at other things. The warning signs. I love the withholding tax. I never even thought about that. That's an absolutely huge one, because that kind of tells you the story that's not necessarily being told. And I think paying attention to some of those things, but the outlook's not. We're not terrible. It's not terrible. Yeah. We're going to kind of be in this kind of market that's going to have volatility, and by adding other asset classes can help reduce the volatility of an individual portfolio so they can get the better outcomes.
Yeah, and not get knocked out at a terrible time, right?
Right.
Like, that's bad investment decision making tends to be exacerbated in times of stress, right?
Right.
Either in times of greed or fear, right? In being able to grind out a consistent return over time, not only leads to better long-term outcomes, but it helps minimize the risk of making a poor decision at an inopportune time. And Robert, you know that so much of your job is to coach people away from being too greedy when things look easy,
Right.
and also to coach people away from being too fearful when things look like an outright calamity. Unfortunately, right now we're somewhere in between. The economy looks good. Obviously, financial assets are pretty rich again. But there are still opportunities to generate outsized returns relative to inflation, relative to risk-free rates, certainly relative to fixed income and duration. And I like our chances in various democratized alternatives to at least compete with equities and do it with far less volatility and downside risk.
I love it. I really appreciate you taking the time. I know that you're a very, very busy man running around, especially with all being on CNBC, being on Fox Business, Fox News, all these different places. Thank you. Thank you for taking the time. Really appreciate it. Just want to say thank you to everyone for listening this week. We'll see you next week. Wealth Strategies Unleashed with Concenture Wealth Management. Thank you.